Welcome back. You're still tuned into Halftime Report. Well, with a gross debt of around 4,000 odd crores on their books, Piramal Pharma is looking to improve their debt ratios further by the end of FY24. While speaking to me, Nandini Piramal, Chairperson of Piramal Pharma, she says that debt improvement will be driven by organic growth in revenue and EBITDA. Listen in to the excerpts of this exclusive.
We knew when we were listing that we were not part of the index funds anymore. And the index funds had to exit the moment we listed. And so that led to a phase of volatility as, you know, index funds were listing, domestic funds didn't know us. And so we had to educate the market. So I think we've spent the last year actually doing a turnaround both in the underlying business. We did a rights issue, which actually reduced debt. And we then focused on educating investors and kind of saying this is our business because we're a little bit of a different business to most pharmaceutical companies. Because if you think about it, our major business is contract manufacturing, where we make drugs for other people, hospital generics, which is a little different again than branded generics, and then we have a over-the-counter drugs portfolio. So it's a little bit different to others, and so we had to actually educate people and say, look, this is how we work, this is kind of how the business is. We've got 17 manufacturing sites that are spread across the UK, the US, Canada, as well as India. So we're just a little bit of a difference.
Okay, well, I'm going to get to, discussing the verticals in just a bit, but you raised around 1,050 crores via rights issue successfully. How much of that was used to pay off debt?
The majority of it was used to pay off debt. We actually reduced our debt to equity to about 3.1 at the last quarter. And the plan is that we want to keep it, below 3 for this end of this financial year. And then beyond that, we'll see.
So what is the gross debt on books right now?
It's about 4,000 crores.
Okay, so what would be an ideal figure?
I think we'd like to, as I said, right now the aim is to get to below 3. And next year we'll talk more about it.
Okay, all right. In terms of the debt reduction, do you think that having this kind of debt on your books is probably going to constrain you in terms of growth?
I think we've done a fair amount of debt reduction. I think we're reasonably comfortable with keeping it below 3. And I think as we think the business improves, you'll see organic growth in revenue and EBITDA will mean that the ratios are actually quite comfortable.
And below 3 would be a target by when?
We're aiming to be between the end of this financial year.
Okay, all right. That would be FY24?
Yeah.
Okay, all right. Now let's get to the business and the verticals. The CDMO business is majority of a business, over 50% in terms of sales. And yes, it is a difficult model to understand because you do cater to multiple, multiple models of the pharmaceutical space. Just tell us how exactly is business doing within that space currently?
So I think business is doing very well. We've recovered from actually a very tough year. And we've seen very good order inflows, especially in our commercial on-patent book. So as a business, we were moving from a transition from doing generic APIs and generic formulations to doing more on-patent work. And the other transition that we were making, we were doing a lot more integrated project. So what we define as integrated is that it'll cover more than 2 sites. So for example, it could be that you would make something in India and then finish it in the UK or the US. So for example, we announced that we got our first ADC to fill finish project, which includes a mAb. So we'll make the mAb at our associate company, Yapan Bio. Then, 3-6 months later, once the mAb is made, it'll go to Grangemouth, where, we'll do the ADC and the conjugation. And then post that, it'll go to our Lexington facility. So that's in a way a very ideal integrated project. But it could also mean that, we make the API at a plant in Digwal and we make the formulation at formulations plant in Pithampur. Okay. So there are different modalities of that.
Well, the CDMO business, like you mentioned, it has seen challenges, and one of the bigger challenges has been the biotech funding, which has seen a slowdown in the US. How has business been impacted?
So if you think about it, in the last 3 years, there's been the lowest funding of biotechs. there's been a challenge because as interest rates have risen, people have decided that they would rather invest in other things rather than the biotechs, which by definition are risky. I think last year saw the lowest number of IPOs in the US for biotechs, as well as probably the highest number of bankruptcies. Now that has affected our development order book. That's the things that start out in phase 1 and phase 2, and you actually do the work in that. But the benefit that we've had is that some of the work that we've done with biotechs previously that are past the proof of concept stage and are about to go to commercial, that commercial on-patent book has actually proven to give us good orders. So it is a mixed bag.
Okay, so your CDMO business grew around 12 to 13% in the previous quarter. What are you probably targeting?
So I think for the second half, I think we're saying mid-teens growth and a significant improvement in EBITDA.
Okay, and when it comes to order inflow, will it probably be better in FY25 versus FY24, or do you see these challenges continue?
I think in FY25, I think it will depend on what happens to interest rates in the future, as well as what happens in the wider biotech funding framework.
And what is your sense on the wider biotech?
So if the most optimistic people say September, other people say January, so I think we're going to plan and see how it happens.
Okay.